Welcome back, everyone. We're thrilled to jump into our next session. So I'm Stéphane Renevier, one of the analysts here at Finimize, and it's a pleasure to be joined by Michael Howell from CrossBorder Capital and by Sébastien Page from T. Rowe Price for this session on how to build a portfolio that survives volatility. I won't lie, I'm pretty excited about this session. I've actually written a lot about this theme this year, and I honestly can't wait. What are your views? So in terms of this session, it's going to be a bit different from some of the others. So it's going to be a punchy 30-minute panel session with our two experts. And because our speakers will be basically dropping gold the whole time, we're skipping the Q&A to really let them run at full speed. Anyway, without further ado, Michael, Sébastien, it's a real pleasure to have you with us today. Welcome to the Modern Investor Summit.
Thank you. Great to be here.
Thanks, Stéphane.
So actually, Michael, my first question to you is, we're heading into 2026 with an environment that, on paper, on the surface, looks anything but normal. Yet, your work actually argue that if you focus on the right indicators, today's environment is actually remarkably normal, almost textbook. So kick us off. What's the single most important variable driving markets today, and what is it telling us right now?
Well, let me foreshadow that by saying that if you're going to build a portfolio that transcends volatility, you've got to start doing it pretty quickly, because next year could be a very volatile year. And I say that because the perspective we have is to try and understand cycles, and particularly the global liquidity cycle. And as you say, that is the thing that looks or has been very normal over the last few years. In actual fact, we've been bullish for 3.5 years now, pretty much since the bottom of the global liquidity cycle. Liquidity is really the main driver of what happens to asset allocation and markets. We don't think it's economics. In actual fact, it's very difficult to discern a business cycle at any time since the end of the COVID emergency. Economies have generally flatlined, and actually, to be cynical, we haven't had any US economic data for quite a few weeks now, but markets have still sort of traveled on. So I think you've got to understand what really drives these markets, and it's liquidity. And the flow of liquidity is likely to be interrupted next year by really a couple of factors. I mean, one is that the Federal Reserve is uncertain about what it should be doing. Should it be doing QE? Should it be doing QT? Should it be doing some cocktail of the two, or some hybrid? We just don't know. It's got to come clean on that, because it's a critical element in terms of US monetary policy. And the other thing is that sitting out there, really courtesy of the travails of COVID, is something called the debt maturity wall, which is a lot of debt that is coming back into the system to be refinanced. And that debt was turned out during the zero interest rate years of COVID. And that's a sort of bogey that markets have got to jump. So I think that there's a lot of uncertainty, let's put it that way.
Thank you. Sébastien, do you agree? From your broader macro perspective, does today's environment rhyme with previous cycles? In what ways does it feel a bit more unique?
I agree with Michael that liquidity is driving markets. It's also distorting markets' reaction to traditional economic indicators. Look, Stéphane, there are 4 indicators that have pointed to a recession for about the last 2 years. And no one's talking about them because they've been so wrong. But if you look at these indicators historically, they're quite accurate in predicting a recession. The yield curve is disinverting. Historically, that has been not a perfect signal. It's called 12 out of the last 10 recessions, but it's been a pretty good signal. Second, industrial PMIs, purchasing managers indices in the US, have been signaling contraction for 3 years. Third, the housing market activity is at a 10-year low. That historically is a precursor of recession. And the last one is unemployment. That's the one that maybe people are still talking about, but unemployment is up by 90 basis points, 90. And there's no time in history when we had such a jump in unemployment that we've been able to stop it. It's like an unstoppable train. It's always, historically, ended in a recession. All the times we've seen such an increase in unemployment. I got to say, though, like Michael, I'm actually generally bullish. And it sounded like Michael might be turning more pessimistic for next year. I share the necessity of risk management in the current environment. But I don't think it's a traditional cycle. We've been 4 indicators that have been completely wrong. Why have they been wrong? Because in great part right now of the AI spending cycle, but also because of what Michael talked about, 20 trillion in global stimulus. This has been a distorting field for any kind of textbook analytics using historical economic relationships. And the markets aren't expecting a recession. The price earnings ratio are at 23 on the S&P 500. The dividend yield is about the same as the dot-com bubble. The price to sales ratio is higher than during the dot-com bubble. The price to book ratio is higher than during the dot-com bubble. So if the market's expecting a recession, someone has got to tell the market. And spreads are at an all-time tight. So look, the economy is growing. It's actually growing at a healthy clip in the US. I'm generally positive on the economy. I just think the topic of our panel today is the number one topic investors should be thinking about: how to build portfolios that will be resilient for increased volatility over the next 12 months. You can say that at any point in time. It always sounds smart to say volatility is going to increase. But I do think that when valuations are that high, it introduces fragility. One more quick thing, Stefan. Alan Greenspan said in the late 90s, in the lead up to the dot-com bubble, irrational exuberance. And actually, people think he said this. It was a rhetorical question. If you go back to the historical record, he was asking, when does irrational exuberance create asset bubbles? And then when the bubble crashed for the dot-com era in 2000, 2001, people said, well, Greenspan was right. Fast forward to the great financial crisis, 2008, 2009, we invited him. I was at State Street at the time to present. And he said, in a grandiose way, we as an industry have failed at risk management. And I always remember my colleague turned to me and said, do you think he includes himself when he says we as an industry? Because Greenspan's been blamed for easy money, which has created bubbles. Well, this is where we are now. Michael's talking about liquidity. We're talking about easy money. The bottom line is we have to remember about risk management is that Greenspan said the words in a question, irrational exuberance, in December of 1996. The NASDAQ went up by 300% for the following 3 years. So to me, risk management, I don't think today we should scare all investors into all going to cash. Risk management is about managing both the upside and the downside. It's about making money. It's about being invested. It's about navigating bubbles responsibly. That's the point I want to make today.
Thank you, Sébastien. Let's continue and let's try to make it, as you say, now, like, what can we do in this environment? So I think that's the one thing you both agree. There's a lot of uncertainty. There is the potential for higher volatility. Of course, that creates both opportunities, but also some risks, as you've just mentioned. So, should investors lean even more heavily on kind of broad diversification in this kind of environment? Or does this environment actually reward more concentrated, high conviction positions? How should investors think about finding the right balance between the two? Michael?
Well, I've always had the view that what you should do is put all your eggs in one basket and watch the basket pretty closely, because I think that's the best way to make money. You can over diversify, and I think that's a risk. And one of the things that I think definitely hasn't worked and certainly won't work in the future is the traditional 60-40 portfolio. I think you've got to be a lot more active. And I think this environment pays itself to actually be an active asset allocator. I simply just don't believe you can be passive. But the great paradox is that the world is turning passive because so many 401k plans are basically in target age funds, which basically don't do very much asset allocation. So I think you've got to make money, you've got to be active. And I think the thing to look at, as Sébastien is talking about, is to first of all understand the fact the markets are not going to go up forever. They could be volatile. You need to understand what is driving these markets. And the other thing I think one needs to do is to actually be aware that those drivers are increasingly in the hands of governments. So, I've in all my years in markets, I've never seen an environment as we face today where you're really looking very closely, almost minute by minute, to decisions that are being made by governments, whether it's how much funding, how much short-term funding the US government is going to make, what's the size of the deficit, what's the People's Bank of China going to do, and these have become really crucial drivers of markets. And at the end of the day, my prognosis for next year is that I think we're close to a financial crisis. We may avoid it, but that really is in the hands of the Federal Reserve, and I'm not wholly persuaded that they're on board with this. And the other is just look at the risk for inflation. What you're getting in almost every country worldwide now, because it's the path of least resistance, is that governments are funding themselves through the short end of the bond market, in other words, through bills. That means monetization. Monetization always ends badly. It means higher inflation. And is it any wonder that the gold price and the silver price are soaring? Because a lot of investors are getting on board with that idea. So I think that, looking forward, one's got to have inflation protection in a portfolio. But it really, there's no other way to make money than to actually try and understand what is driving the driving forces of markets. And one of the things that is going to be foremost in the headlines next year, in my view, is the inflation risk. I mean, everybody really understands that, their personal inflation rates are a lot more than the quoted figures that come out of governments, like 2 or 3%. I mean, we're talking much higher single figure increases.
So Michael's clearly leaning on a more kind of high conviction, active exposure. Sébastien, what's your view?
Will diversification work going forward? I'm going to rephrase the question. The problem with diversification is that it never works when you look backwards. You can always pick one single investment that has beaten all the other investments. But if you're managing risk, it might be prudent to not put all your eggs in one basket. So maybe, Michael, here we have a debate. I'd love to ask you which basket. Maybe it's US large cap growth stocks. That's been the one basket for the last 10 years. And it's true that diversification has not worked well for asset allocators over several years. With rates coming down and with growth right now, Atlanta Fed GDP now at around 4%. If you add, say, 3% inflation, I agree with Michael on the upside risk to inflation, you get 7% nominal growth. That's higher nominal growth than any calendar year between the global financial crisis and COVID. So if rates come down and we're running at, say, 6-7% nominal growth, that should provide an opportunity for market broadening. Small and mid caps should do okay. Value stocks should do okay relative to growth stocks that are tied to the AI theme, as long as we get a convergence in the earnings growth, which is starting to happen. So we are long the market broadening in our tactical allocation portfolios. Look, I mentioned the price earnings ratio on the S&P 500 is 23. That's the 95th percentile of its historical range. But if you look at an equal weighted index, it's actually just only slightly above its long run average. Or if you look at the MSCI All Country World Index, equal weighted, the average stock in the world, you actually get a valuation of price earnings ratio for 12 months of about 15. The long run 30-year average is about 14. So it's interesting to see with all the bubble talk that there are plenty of stocks in terms of the number of stocks globally and in the US that are trading at reasonable valuations. Now, granted, they're not seeing the same earnings growth, but still there's an opportunity in my mind for broadening because concentration is not just high, it's at an all-time high in financial markets. So something's gonna break. You can, with a broadening trade, it can actually get good downside protection as well. So look, I understand diversification doesn't always work. It certainly doesn't work when you look backwards, but it is a strategy I will advocate today. So maybe Michael and I will have an argument. Maybe we'll have an argument on how you diversify. I will recognize, though, that when markets crash, correlations do go up significantly. This is trite. We all know this. We have a sophisticated audience today. I wrote a paper back in 2008 titled The Myth of Diversification. Probably a title Michael would like. I don't know. I'm trying to get Michael to smile here. The Myth of Diversification. I looked at US stocks and non-US stocks when the stock market was down by 15% or more in a month, and the correlation went up to 90%. We all know this, and it happens across asset classes. They tend to crash together. But what we don't pay enough attention to is that when markets were up by several standard deviations, the correlation cratered. So not only did you get diversification to not really work on the downside in crashes, but it worked best exactly when you don't want it to work, when the markets rallies. So that's a challenge with diversification. If you can't diversify, hedge, maybe is where we'll end up today.
Yeah. Now, Michael, you're favoring a more active approach. But obviously, a more active approach also requires to make forecasts. And as we all know, making forecasts about the future is very difficult. So what, do you have any practical tips or framework for investors today in terms of, how they can actually be better at making these active decisions? And I guess, with global liquidity, that's probably a good starting point.
Yeah, I think that, certainly we look at liquidity, and that, in our view, is a major driver of asset markets. But I think that in terms of a practical way of going forward, we tend to think in terms of a core portfolio and a tactical overlay. And I think that, one's got to think, first of all, about what do you put in your core portfolio. And that, to a very large extent, really depends upon a number of factors. One of those is age. One of those is the sort of tax structure of the domicile you live in. That clearly has bearing. Another is the inflation prospects. Are you in a high inflation or a low inflation environment? And those would really dictate what you want in a core portfolio. I think looking forward, my view is that a core portfolio has to have many, many more dedicated monetary inflation hedges in it because of the way that governments are behaving. And I think, as I said, the sort of reckless behavior of a lot of governments and the inability to rein back government spending and what's more to fund it through expansion of bank balance sheets is a worry for future inflation. Therefore, you've got to have more gold, you've got to have more precious metals, you've probably got to have cryptocurrencies in the form of Bitcoin, because that's a demonstrable monetary hedge and has been in the last decade. You've got to have probably prime residential real estate in there too. You probably don't want a lot of government debt, particularly long duration debt. You want good solid companies that have got pricing power, and that should be in your core portfolio. Tactically, which is an overlay on that, and you can choose how much as a tactical overlay you want, and that might be 20% of the portfolio. If you're more conservative, it might be less, or if you're more risky, it may be more. But I think that tactical portfolio, in my view, has got to be defensive looking into next year. And the reason I say that is because of the evolution of the cycle, as you sort of foreshadowed at the beginning, looks to us really normal. And that's the worrying point in many ways looking into next year, for the simple reason we've had a very nice evolution that you've seen equities outperform, credits outperform. You've seen within the equity markets things like technology being the leader, as it always is. You've seen the financials come through about mid-cycle, as they typically do. You've seen mining stocks and commodities performing strongly late in the cycle, as they're doing now. The problem is the next shoe to drop is that the market is likely to hit some sort of air pocket going into 2026, because that's typically the end of the cycle. Now, it may be that it's extended, but the reasons for extension I can't quite see at the moment, because as far as I can see, liquidity conditions are going to tighten next year. And it may well be that the reason that liquidity conditions tighten is because you've got a very strong economy. And I agree 100% with what Sebastian's saying. I think the US economy looks very robust. And I think looking into next year, it could get even more robust because of the scale of capex which is going on. So I'm actually quite bullish on the US economy. The trouble is that I think we're going to get inflation too. And that's why I think nominal GDP growth, as Sebastian rightly says, is going to be a knockout year. But I don't necessarily believe that the markets will do well in that environment.
Sébastien, what's your AAA portfolio for these uncertain times?
Well, I have the perfect cop-out answer, Stefan. Our asset allocation committee is currently neutral between stocks and bonds. We are short duration and long inflation protection tactically. That's with a horizon of 6 to 18 months. So Michael and I agree on this. Our process is to look at relative valuations, macro factors, fundamentals, as well as sentiment and liquidity. We are positioned for a market broadening. We do like international value stocks. They have rallied They have done well this year, and they're still cheap by historical standards relative to the rest of capital markets. And so I like the US. I like the US economy. I talked about 6-7% nominal growth. But from a tactical portfolio positioning perspective, I like to have broad diversification between non-US and US stocks. So that's how we're positioned, Stefan.
And what's your view on crypto and Bitcoin specifically? Does it have a role in your portfolio?
It has a role for investors who have the risk tolerance and the understanding of what it can do in a portfolio context. I don't think it has a role as a single investment, as something that you bet everything on. I think some people right now are probably feeling the pain of the down leg in crypto markets, including in Bitcoin. What's interesting, Stefan, is I heard a statistic. I almost fell off my chair. It was in a meeting here a few weeks ago. We're talking about digital assets. For investors of a generation, say 30 years old and below, I don't know how many of those investors we have in our audience. Maybe you can tell me, Stefan. But there are more people that hold crypto, digital assets, than stocks and bonds. I find that generational difference fascinating.
Yeah, it's a pretty impressive stat. I won't lie. Okay.
In fact, I was going to say the fact is that Bitcoin is the most liquidity sensitive asset on the planet. And we've seen that both recently and over the last decade or so. So, if you want to move with the liquidity cycle, just watch the Bitcoin price. It matters hugely.
And I think, an important point related to that is I think, a lot of investors kind of downplay the importance of position sizing, what allocation, like what percentage of your portfolio you allocate to an asset if it's, a lot riskier, a lot more volatile compared to kind of a safer asset. So maybe we can keep the conversation kind of practical, and maybe, do you have any tips on portfolio allocation, how to actually allocate across the different asset classes?
Well, if I jump in first, my view would be that what you need to do is to volatility size positions. I think that makes eminent sense. It's a prudent thing to do. So I think that's one thing to say. I think the other thing, which I'm probably more skeptical about, is whether correlation structures are stable at all. So I think that if you move through the investment cycle, correlations change so much. I think it's very, very difficult to use traditional tools to asset allocate. But I think volatility sizing does make a lot of difference.
Sébastien, any views on portfolio allocation?
The first thing I would say is that for a lot of individual investors, the allocation to stocks is too low. If you look at positioning data over the life cycle, even if you're at retirement, you still have hopefully another 20, 25, 30 years of life. So when people have a long time horizon, you can look at their average stock allocation when they're self-directed, and you usually find something that's lower than would be expected if you look at life cycle models and very long-term market return and risk expectations. Now, this is dangerous to say when valuations are so high. This is a strategic allocation statement. When investors look at it and they do their financial plan, they often find they're underinvested in stocks. However, if we're talking about risk management and diversifying into 2026, which we both think is going to be bumpy, I still think need treasuries, high quality bonds in your portfolio, because if there is a real growth shock, these assets should rally. But diversification to me is much broader. We're both talking about inflation risk. I think inflation hedges like inflation sensitive stocks of energy companies or real estate or utilities, they all hedge inflation at different horizons. Precious metals would be part of that as well. So maybe both Michael and I agree on that. Alternatives are interesting, difficult to access and to select for individual investors. But let me tell you something, providers of alternatives and liquid assets really, really want your money if you're a retail individual investor. So they're coming. They're going to do everything they can to get in your pension plan, to make it easier for you to access these asset classes. If you do it carefully, I think that's a good diversifier. And then, there are hedged equity strategies out there that I think are particularly interesting in the current environment. So you have cash, you haven't deployed it, you're worried that market valuations are really high. Well, you still want the upside, because what's interesting, my Greenspan example in 96, irrational exuberance, and then you get 300% return for the next 3 years, 300 total. To get the upside while managing the downside, I think hedged equity strategies are interesting. The best one will offer you like 80% of the upside, but with about half the exposure to large losses. Because of the failures of diversification that we're talking about, because of the high valuations, I think hedged equity, and they're even available in easy to access vehicles. I think that's an interesting strategy right now, given the point we are in the cycle. And Stefan, just one thing about all-time highs in markets and high valuations, they don't necessarily predict historically very low returns for the next 12 months. In fact, if you go back to the 1990s, all-time highs in stocks were followed on average over 12 months by 12% average returns. And the unconditional average return of any rolling 12-month period over that period was really, really good. It was 10%. But you actually ended up on average can hide a lot of things, but on average, with a higher 12-month return following all-time highs. So I'm looking for asymmetries. That's what I'm looking for right now. Something that gives me upside, but that helps me control my downside in the environment, even if I give up part of the upside to make that happen.
Yeah, I think Sébastien makes a great point about, generally people have too low equity exposure in portfolios. I think that's very well said. And I think that, traditional asset allocations would tend to convince people that as they get towards retirement, they start to go more into fixed income. I think that's wrong. I think he's absolutely right to point that out. And, basically, your equity exposure should be dictated by effectively your investment time horizon. And even somebody sort of age 70 is going to have a horizon of probably 10 to 15 years at least, which means they want a lot of equity. And I think that makes sense. Now, tactically, there may be, as Sébastien says, a question mark whether you want to load up right now, but certainly buy on weakness, I think, is a great strategy. And then I think the other thing is, if you want to build a portfolio, a robust portfolio, start looking at tips. I mean, at the end of the day, it's really, really hard to get a 2% real yield out of financial markets in the long term. The government at the moment is actually offering pretty much that in the tips market. So that's not a bad investment. It could be volatile if real interest rates change, but if you're a holder, it looks pretty good.
Now, for that last question, I'll give you 1 minute each. So it has to be very short and very to the point. And it's a very practical question. Basically, what are the most concrete practical steps that our audience can actually take tomorrow morning to build a better portfolio? And feel free to reiterate, the main points that you've already talked about earlier.
Do you want me to go first? Okay.
Yeah, please.
Well, I think what I would say is think about core and think about tactical overlay. So you've got to divide your portfolio into two parts, and the division would really depend on age of the individual concerned and the time horizon. So that's number one. I think number two is you've got to look at the drivers of markets. What really drives both the core portfolio and the tactical overlay. The tactical overlay is much more likely to be related to the liquidity cycle. So try and understand what the central banks are doing, not necessarily, reading their lips. Watching their hands is really a critical thing to do as well. How much money are they putting in the system? And in terms of the core portfolio, what really matters, I think, in the long term, as apart from age structure, is actually the inflation outlook. So what I would do in terms of a practical step is to build up exposure to inflation hedges on any weakness and make sure you've got that protection ready for 2026, because I think that's going to be the big surprise for many people.
Sébastien, you've got 45 seconds.
Take a 60-40 portfolio, make it a 60-30-10. Take the 10, split it into 3 diversifiers, alternatives or semi-liquid alternatives, private credit or private equity if you can have access. A hedged equity strategy I mentioned earlier, widely available, and some form of inflation risk, I like real asset equities, energy companies, precious metals, and so on. 60-40, 60-30-10, take the 10, split it into these 3 buckets: private, hedged equity, inflation hedging on the equity side.
Doesn't get any clearer than that. Thank you so much. Michael, Sébastien, thank you so much for sharing those insights, and thank you everyone for listening. That brings this session to a close, but don't worry, there is another one right after a short break. So see you very soon.
Thanks.